Good evening. Thank you very much indeed for coming today. What we're going to try and do between us, Padraic and myself, is to run through the paper that you may have read, which we co-authored with several other people from the IMF. The background to the paper, if you ever get the opportunity to be involved in a similar paper, I would suggest you take it with open arms. The background is that the IMF were keen to explore the topic of the interaction between Basel III and Solvency II. They came to the International Actuarial Association and asked, in effect, for volunteers to provide a more actuarial side of things to that. And Padraic and I are both on a relevant IAA committee, and so we happen to be the actuaries on hand at the time. So it's a great privilege to have been involved. And one of the great advantages of that is that they had a lot of resource and enthusiasm to see this paper produced relatively quickly, and therefore it was a relatively painless effort, at least on my perspective, but I think also from Padraic as well. So the agenda that we want to cover this evening is just to look at some of the similarities and differences between banks and insurers, their business models, etc., and between the two new regulatory frameworks that are coming, or one assumes are coming into force for these two entity types. It was written in the good old days when Solvency II was expected to have already arrived by now. That hasn't quite happened, but hopefully the perspective that we can bring on the Solvency II is not completely unlike what will eventually come through with Solvency II. So it's based on this working party paper, and there's a link to it shown on the slide. And what we also want to do towards the latter half of our presentation is to cover some of the unintended consequences of having these two relatively all-embracing types of regulatory frameworks coming down the tracks at roughly the same time, but with quite different histories and drivers generating the precise details within them. So that's the main theme. The idea is to try and encourage us all to think about these unintended consequences, and I hope we will have a good discussion after the opening presentations that will address that. I'm going to focus on the first bullet point, the similarities and differences between banks and insurers, some of the second sub-bullet point, and then I'm going to hand over to Padraic. So just to give you an overview of the paper, it does focus on these two different regulatory frameworks. It picks up on the idea that Basel III has got a different geographic focus as well as a different business focus, and but we do want it to be a framework that will lead to discussion about these potential unintended consequences. And we've listed, and we'll go through a few of them towards the end, but there are three that we particularly want to highlight: cost of capital, funding patterns, and interconnectedness, and this idea that you might see some product or risk migration between banks and insurers, and in fact also maybe away from both banks and insurers to other parties. The paper will focus primarily on the Pillar 1 aspect of capital requirements, very conscious that that isn't necessarily the thing that is uppermost in terms of what bites for capital requirements, particularly for insurers. But the paper is quite long as it is. To have included full details of Pillar 2 as well as Pillar 1 just seemed to us to be impractical. The way that I like to think about business models for banks and insurers is to look at the fundamental types of business and the way in which they interact with the rest of the economy. And one way of looking at that, or slicing that up, is to look at the role of money itself, and therefore the roles that these two different types of entities play within money and its role in the economy. So money has in my opinion, two main uses or two main roles within an economy. The first is as a way of providing payments and exchanging goods and services. So with money, we can go along to the supermarket and we can buy our groceries with that money. The other role of money is as a store of value. So we can put our money away for a rainy day and we can save up with it. These two different entity types, banks and insurers, mainly focus on two different roles. So the banks tend to focus on the first of those roles, and they provide, in the main, a means of payment, or that's what their role in the economy is, whereas insurers focus much more on the store of value, at least when you're talking about life insurers. And we've listed on this slide a variety of implications that follow through from that, and focus primarily on one or other of those types of entities. And you can see that there's some quite significant differences because of these significant differences in the roles that money plays in society. And perhaps the most important one, at least as far as regulators are concerned, is the bottom line, which is that the governments, in their infinite wisdom during the credit crisis, took the view that it was more important to ensure people could actually go out and buy their groceries than it was important for them to have long-term secure savings. Maybe that won't always be the case, but generally speaking, the political framework is that it's more important to protect and ensure that banks actually do their job than it is that insurers do their job. So we see differences in the political views that govern the way in which insurers and banks operate. Now, of course, the world doesn't split into two neat categories and compartments. The reality is that there is some overlap between different types of organizations. And I've just listed here in this slide a few of the overlaps noted in the paper. Things like some of the investment and savings products that you can buy both from a bank or from an insurer, or at least things that look relatively similar. Investment and savings is perhaps the most obvious overlap, but there are other types of overlaps, other types of more protection-orientated products, where again, banks and insurers can do relatively similar things, maybe not identical, but they can be quite similar in the way that their end economic exposures work. Banks and insurers also have different ways in which they fund themselves. So that's another difference in their business model or business structure. And we've got on this slide just an analysis of the different contributors to funding bases of these two types of entities. The key thing there to note is that in the insurers, most of insurers' capital can be viewed as coming from the individual policyholders providing those premiums and providing the savings within which the insurance asset base is built up. Whereas banks have a much more spread out type of funding, and moreover, banks tend to be more interconnected, i.e. they tend to hold more of each other's paper than is the case with insurers. Banks and insurers also typically have different capital levels. Again, we've got a chart here lifted from the paper that just highlights some of the differences in the capital levels that different types of banks and insurers have. Now, ideally, with this type of analysis, you would adjust for the risks that the entities actually face, and that in itself is a rather challenging undertaking. And so when people look at this type of thing, they tend to focus on the headline numbers, particularly if they are politicians, and one can see from this that reinsurers look to be in a relatively good state, or at least they did at the time this was cut relative to banks. And that maybe is one of the reasons why banking capital requirements have been going up, or at least the incentive was to change it at that time. Banks and insurers also have different accounting bases. The way in which their assets and liabilities are calculated, and the way in which they take into account their own credit position does vary. And we just try to highlight a few of the changes there, and or a few of the differences, and also some of the ways in which that picture might be changing through time. Banks tend to have a more retrospective way of doing their accounting than insurers, or at least insurers will do under Solvency II. And that type of analysis is relevant to the way in which organizations and regulators think about countercyclicality, because the more retrospective it is, the more stable the accounting bases in theory ought to be, and therefore the more, or the less exposed you perhaps ought to be to countercyclicality. That clearly didn't prove to be the case in reality, and so again, looking through these things, that is going to be a work in progress, how those accounting frameworks operate. I mentioned that the paper focuses on Pillar 1 rather than Pillar 2. There's an interesting angle to that, which is the question of, do banks place more attention on Pillar 1 versus Pillar 2 than insurers, or is it the opposite the case? When we discussed this paper with a few colleagues from regulators, the general view that was expressed back to us was that insurers typically pay less attention to Pillar 1 than to Pillar 2 than banks do. So they're less constrained by the Pillar 1 computation. And I'd just like you to bear that in mind when you read the paper. Now, turning to the Basel III and Solvency II frameworks themselves, I've got here a slide that just sets out the overall structure of the capital requirements that applies to Basel III, and the next slide shows the same kind of thing for Solvency II. There are differences, but in very, very, very high level, both of these regulatory frameworks are trying to achieve similar goals. So both of them have a three-pillar type framework where you have formal capital requirements under Pillar 1. Pillar 2 is more about governance and risk management and own capital assessment, and Pillar 3 is a more disclosure-orientated approach. It's just that the types of risks that are covered are slightly different. Here you can see that banks seem to spend a lot of time on credit and market, somewhat less on operational risk, whereas if we turn to the Solvency II standard formula, that has market as high up on its agenda, but also a variety of other types of risk. And this just reflects the different ways in which, or the different types of risks that are most important for those two different entity types. The actual way in which the computations operate, again, they differ, but at a very high level, as we've highlighted in the paper, you can still see some similarities and commonalities between those two regulatory frameworks. Turning to the detail of Basel III and Solvency II, they do have different histories and therefore different drivers. And this, I guess, was the particular reason why we wanted to, or the IMF was keen to commission this piece of research. You have two different frameworks that might have ended up being crafted in different ways just because of the way in which politics or history had operated, and was that a sensible way to do regulation. I've got here just a summary of a few of the differences in the history and drivers behind Basel III and Solvency II. So you can see that Basel III, you could argue, is ultimately driven by regulators, whereas Solvency II is ultimately driven by a political body. Now, the reality is, of course, a little bit more fuzzy with both of those two things. And Solvency II, there is an equivalent to Solvency II called the Capital Requirements Directive, which is also politically driven, which is how Basel III is being implemented in the EU. But a few of the other points perhaps are more clearly delineated. So the main driver behind Basel III relative to Basel II, it seems to me, was the need to raise capital, to increase the amount of capital that banks had, and also to increase the quality of that capital. And so the explicit goal that regulators and politicians have followed to create Basel III. Solvency II, in contrast, might have had some of those angles, but its main driver was to do with achieving greater harmonization and greater coherence to the way in which regulation across Europe operates. And one of the interesting things that I see has happened since this paper is that the Solvency II you can think of as a part of the wider European journey that we are all on. And it is, in my opinion, not a coincidence that Solvency II has got slightly derailed in its implementation at just the same time as some of the other European journey aspects, like the Eurozone, have also come under a number of challenges. In terms of the way in which the capital operates, you can see some similarities between Basel III and Solvency II. They both have this overarching goal that capital is there to absorb unexpected losses, and they both have some appreciation of the idea of capital tiering and of the different types of capital and the relevance of different types of capital to different sorts of unexpected losses. So that the concepts at a very high level are relatively similar. At the detail, however, it becomes somewhat less clear quite why we've ended up with Basel III and Solvency II proposed rules. So some of the differences are justified given the different business models that I've just elucidated, things like the treatment of ancillary owned funds, which is a more insurance type of approach to capital and is maybe more justified in the insurance sphere because insurers are maybe less exposed to runs. You can't have people taking quite a lot of their policy money out for certain types of policy contracts. But other types of capital tiering rules do seem less clear to us how we've ended up where we have done between Basel III and Solvency II. So there are some significant differences in the way in which bail-in proposals are currently structured and some of the treatment of dated instruments and a few of the other points that are noted there. I mentioned that the main driver behind the creation of Basel III versus Basel II is this desire on the part of regulators and politicians to increase the amount of capital that's in the banking system. And the numbers are eye-watering in terms of size. So I've just got here a study or some figures that show just how much extra capital it was viewed banks needed to have. And the Basel III is explicitly going out to try and address that. And this is another chart taken from the paper that just gives you a kind of pictorial representation of some of the ways in which the Basel III capital requirements are going to increase. So the pink, which is the common equity, was really quite low before the crisis, and Basel III is going to increase that noticeably. and which is the message that it's not just about the total quantum of capital, but also the quality of capital. So that's deemed to be the most resilient type of capital. So it's shooting up as well as all the other aspects of the capital requirements. And so what I'm going to do now is to hand over to Padraic, who's going to explore in a little bit more detail how that nice chart that indicates we're going to have more capital actually works in practice. He's going to look at some of the things to do with systemic risk, which is a very important driver in where regulators and politicians are currently when it comes to capital. And then he's going to move on to the possible unintended consequences of these two regulatory frameworks. Thank you.
Thanks, Malcolm. So as Malcolm said, I'm going to look a bit more detail at the capital requirements first of all, and then I'm going to move on and look at some of the potential unintended consequences. So I suppose starting again, looking at the very high level, both Basel III and Solvency II have a risk-based approach. So both of them are intended to reflect the underlying risks, but when we look at the details, really both of them are very complex, and both of them include a number of alternatives along the way. So it becomes very difficult to compare capital requirements in detail. I suppose Basel III is built on the same methodology as Basel II, so both of them use risk-weighted assets. Both of them have three main risk areas, being credit, market, and operational. And the results for those three areas get added together with no allowance for diversification. There isn't one underlying explicit probabilistic basis for Basel III. So unlike Solvency II, which tells us that the intention is to hold capital at 1 in 200 level over 1 year, there isn't a similar statement you can make about Basel III in aggregate. You might be able to make it about individual elements of it. As Malcolm mentioned, the intention is under Basel III was to strengthen the standards considerably. The minimum ratios have increased. What companies can count as capital has been tightened, the definitions, and the calculation of the capital requirements have also increased. I suppose risks of leverage was one of the key learnings, leverage and liquidity from the financial crisis. And Basel III has introduced new requirements in respect of leverage and liquidity, including the leverage ratio comparing capital to non-risk weighted assets, which must be at least 3%. There's a net stable funding ratio, which is funding over long-term assets must be greater than 100% over a 1 year time period. And then liquidity coverage ratio, which says that high-quality liquid assets over total net cash outflows over the next month must be greater than 100%. The detail is included in the paper in any case. It also strengthens requirements for extreme value events with the introduction of a stressed VaR for market risk. So I suppose Basel III is intending to raise the bar quite considerably for banks, and it has that as an explicit objective. On top of that, then, we also have additional charges for systemically important financial institutions. So these aren't really part of Solvency II or BAL as such. They're introduced by the IAS and the Financial Stability Board, and are in addition to really the Basel III and Solvency II. So looking at the banks, first of all, we have a list of 29 banks which are considered too big to fail, and the BCBS published their methodology back in 2011, and they used five indicators really in order to decide whether or not a bank is too big to fail, with those being the ones listed. I suppose the issue here is that really because banks are too big to fail, they effectively have implicit support from the taxpayer, and they don't have to pay for that support. So therefore there's a moral hazard. They're encouraged to load up on as much risk as possible, because in the event of anything negative happened, they would end up being bailed out by governments and taxpayer. So the aim of identifying them as systemically important is to reduce the probability of their failure and to reduce their impact if they do fail. So therefore, there's additional capital requirements of between 1 and 2.5%. In theory, those can go up higher to 3.5%, but 2.5% is the highest so far. Of course, there's there's a bit of a dilemma as well in terms of if you identify these banks as being too big to fail, will that end up with them actually having lower funding costs because now they have explicit support from the government rather than just implicit. So it's a difficult question, to be honest, in terms of the impact of the additional capital charges versus this explicit support. So then moving on to the insurers, Solvency II, I suppose we have absolute and minimum risk-based capital requirements. We have the solvency capital requirement and the minimum capital requirement. There is an explicit probabilistic basis. We do have the 1 in 200 over 1 year, at least for the SCR and perhaps in theory for the MCR. Again, you have a standardized approach or the possibility of using an internal model. And I suppose, again, the promotion of internal models was something that was decided quite early on in Solvency II and is, again, probably one of the lessons or the issues from Basel in terms of the use of internal models led to lower capital requirements being held in banks. And therefore, there's a significant question around for regulators in terms of allowing internal models. And also in terms of expertise in the regulators, are they ever going to be in a position to keep up with the insurers, given the amount of money and resources that insurers can devote to internal models? The ORSA under Pillar 2, I suppose, serves a number of purposes to complement the Pillar 1, including model risk, assessing of solvency needs, comparing your risk profile to the standard formula, etc. Solvency II also requires greater public disclosure if the SCR is not covered and explicit deferral of payments on capital instruments that qualify in Tier 2. So again, for the insurers, we also have a list of systematically important insurers. I suppose these companies that are identified as such will have more intensive supervision. There is intended to be a greater ability for the regulators to resolve these companies. They should have higher loss absorbency in these companies, and I suppose there's been a lot of debate and defense from the insurance industry in terms of little evidence is the statement that traditional insurance generates systemic risk. So therefore, a lot of the focus on this list is on non-traditional insurance. So things such as financial guarantee insurance, credit default swaps, derivatives trading. So really a lot of the activities where insurers and banks are getting very close. That's where a lot of the focus in terms of this paper is on. Variable annuities is also one of the areas that they identify as being an area of non-traditional insurance. Reinsurance was considered as a traditional insurance, and I suppose the indicators are listed there. There are 5, but really the 2 key indicators for insurers are interconnectedness and non-traditional activities. So the non-traditional activities is going to be between a 40 and 50% weight in terms of deciding whether you're a systematically important insurer, and that's all those areas that I listed a minute ago. Interconnectedness in terms of intra-financial assets and liabilities will be a 30 to 40% weight. And I suppose really AIG is probably one of the key reasons why insurers are being included. This list is considered necessary for insurers, given the scale of the issues that emerged in AIG and the fact that it was in the non-traditional insurance area. That really, I suppose, meant that it was necessary to have such a list. So then moving on to look at risk aggregation, I suppose Basel III doesn't fully reflect the importance of diversification, or conversely, it doesn't fully penalize portfolio concentrations because there's an assumption implicit in there of portfolio invariance. Of course, it's possible that the regulator might introduce such features when they're examining and regulating the companies. Basel III also is relatively narrow in terms of the types of risk mitigation contracts that it recognizes, and it's mainly in the area of credit risk mitigation that it gives banks credit for risk mitigating. Whereas Solvency II has much greater explicit recognition of diversification effects and risk interdependencies, so there are a number of correlation matrices in the standard formula to recognize the diversification benefits. And excuse me. And there are also concentration risk is explicitly recognized in a number of risk areas under Solvency II. And different to the banks, again, virtually all types of risk mitigating contracts are recognized under Solvency II. So I suppose all of this means you have very different capital calculation and capital requirements, and then you have very different methods in terms of aggregation. So in aggregate, it becomes very difficult, next to impossible, to compare one portfolio with another. So I suppose then the paper moves on to look at some of the potential unintended consequences of these two processes having been developed very much independently, and with the implementation of them being largely around the same time. So I suppose in particular we identify that there could be unintended consequences in terms of cost of capital, in terms of funding, and in terms of product and or risk migration. There might also be other potential sources of arbitrage, such as tax, supervisory approaches, etc. And really we suggest that this would be an area where I suppose further empirical investigation would be of benefit. So the first area we looked at was cost of capital, and I suppose the framework we used to consider this was Modigliani and Miller, so who would say that funding debt equity ratio doesn't really matter in terms of cost of capital. And really we were looking at it from the reasons why Modigliani and Miller doesn't apply in practice. And one view was that the changes in Basel III should lead to higher costs for banks and affect them more than insurers for the following reasons. So firstly, debt interest deductibility. The fact that debt interest can be deducted means that this affects banks more, as they rely much more heavily on debt financing, and Basel III is explicitly aiming to raise capital requirements. So that should mean, looking at it in isolation, that the banks will be affected more. The question of too big to fail and the implicit deposit protection underpin. Again, this should affect banks more if Basel III is successful in reducing that subsidy that is there at the moment. Solvency II, as we've argued, has much greater scope for risk mitigation than the banks do under Basel III. Some of the capital deductions under Basel III look to be more stringent than those under Solvency II. And Solvency II is explicitly promoting the use of internal models, which again, if taken in isolation, would lead to lower capital requirements for insurers. But on the other hand, there are also arguments going to the contrary. So you might see higher costs for insurers because, firstly, Solvency II is much more fundamental change than moving from Basel II to Basel III. So Basel II to Basel III, right, raising the bar in very explicit areas, and it's, I suppose, pretty well defined what the impacts will be. Solvency II is a very fundamental change in terms of the insurance industry, and therefore could have a bigger impact. There could be greater costs for insurers if they need to unwind undesired positions. Again, this is one of the points that I suppose was written a couple of years ago. Given the transitional measures and everything else that are likely now when we look at Solvency II, that might perhaps help to reduce that issue in the short term. But there's also the fact that there's no or limited market for many insurance liabilities. So therefore, the Modigliani and Miller might be less applicable to insurers in the first place. And as Malcolm noted earlier on, really a lot of this depends on the importance of Pillar 1 versus Pillar 2 and the extent to which firms are capital constrained. So, as he said, it might be more important for banks where there are greater constraints on capital than for insurers who are looking more at Pillar 2 in any case. The next area we looked at was funding patterns and interconnectedness. So, as Malcolm has mentioned, insurers are primarily funded by policyholders. The majority of the funding is upfront, and assets and liabilities are normally linked. Whereas conversely, banks are funded by a wide range of structures. They have substantial short-term funding, and their assets and liabilities are often not linked to the same extent. So the question is, I suppose, to what extent will those funding patterns be impacted by Solvency II or Basel III? And the first issue we identified, I suppose, is one that's currently being considered in the long-term guarantees assessment, is whether Solvency II could reduce demand for banks' long-term instruments or reduce the role of insurers as long-term investors. And particularly that might happen at a time when banks are looking to raise additional capital. So this is a concern that's, I suppose, shared by both regulators and market participants. When we look at the Solvency II standard formula in respect to credit risk, it depends roughly proportionately on ratings and duration. So therefore, firstly, EEA sovereign bonds are zero rated, irrespective of credit rating, and it might favor companies to invest in shorter term, higher rated instruments. Also, Basel III will likely affect banks' demand for and supply of certain types of debt. And we give the example that covered bonds, which are bonds that are covered by a specific pool of assets, might well be favoured relative to unsecured, because covered bonds qualify for LCR and NSFR, whereas senior unsecured bonds don't qualify for liquidity coverage ratios. So you might see a change in terms of the supply of bank debt in any case. Although, again, having said that, there are arguments that the impact might not be so great, because the long term for banks is very different from the long term for insurers. They have a very different perspective on in respect of investment. A lot of insurance demand is liability driven, so it's driven by what policyholders are looking to invest in any case. And also, we have a slide in a minute which shows insurers are not the main buyers of bank debt in any case. And finally, you could argue that changes in appetite will be reflected in changes in price and will just feed through to a higher or lower cost of capital. Also, Basel III is promoting new hybrid structures which will be closer to equity. Solvency II isn't really encouraging such investment by insurers, and Basel will also have an impact on banks' enthusiasm for holding each other's debt. So I suppose there's a number of areas in which the funding patterns of banks and insurers could be impacted. So this slide just shows us the bank's debt funding sources by type of investor, and I suppose when we look at senior bonds, we can see that most of their funding is held by real money funds, and insurers are only 10% of the overall. And similarly, in respect to covered bonds, really, banks themselves are the key investor with 45%, and insurers again have only 10% of banks' debt. So in the paper, we suggest that another issue to consider in relation to funding pattern might be that you might end up with increased interconnectedness via other routes. For example, if both banks and insurers end up targeting the same assets, in particular, you could potentially have an increased demand from both for sovereign debt, given that such instruments are viewed favourably by Pillar 1 of both frameworks. I suppose it's possible that might be mitigated to some extent by insurers' internal model if the internal model reflects the heterogeneity in credit risk across EU sovereigns. But the standards, as we say, for such models have yet to be defined. And again, this paper was probably written before we had seen the full extent of the euro crisis. So I suppose the extent of such risk is much more obvious now, 2 years on from when this paper was written. We were raising the question as to whether insurers were more likely to hurt than banks. I suppose we've seen insurers act very similarly in terms of reducing equity content and so on at the same time. It could also be argued that banks are also inclined to operate in a similar manner because they need to raise capital or reduce leverage and so on at similar points in time. And finally, under Basel, there might be less incentives for banks to own insurance companies because they won't be able to use the insurer's capital to cover their own capital requirements. I suppose that last point is quite a contentious one, and in particular Germany and France are fighting back against that measure quite strongly. The final area of unintended consequences we were looking at was in relation to risk product transfers. So there are a number of areas where banks and insurers are competing directly. We give the example of term certain annuities, for example, can attract higher capital requirements than term deposits, even though it's much the same instrument. But Basel III liquidity requirements may help to reduce some of that disparity. Another example is that equity investments can attract higher capital charges if held in banks than non-life insurers. So conglomerates may move assets between subsidiaries, and that might be exacerbated if higher capital requirements are being introduced by Basel III. We also raised the issue, I suppose, that increased cost of capital, increased focus on risk management, all of this could well result in increased risk being passed on to customers. For example, repricing of annuities based on mortality means the insurer is giving less of a guarantee, the policyholder ends up taking more risk. Similarly, the shift from defined benefit to defined contribution ends up with more risk being passed on to the individual and away from the companies. And I suppose there has to be a question raised as to what the appropriate balance is for society as a whole. Where is it best to have that risk being taken? And the possible impact on behavior of long-term investors, I suppose, was one of the key questions we were raising. And again, it's been looked at in the long-term guarantees assessment. We also suggest that potentially you could see risk migrating away from both sectors, for example, through the use of securitization, reinsurance, shadow banking. We could end up with a replay of the Basel II originate and transfer business model. So banks and insurance companies might end up taking less risk and passing it on to a third party. And that then has obvious implications for transparency, oversight, and in particular under Solvency II, the question of equivalence between different jurisdictions. So we were suggesting that there's a number of policy considerations, and in particular, communication between insurance and banking regulators was one thing, because the two processes have been largely developed independently, and there's a lot of scope, I suppose, for these arbitrage opportunities. There might also be a need to expand the regulatory perimeter, in particular if risk does end up migrating to shadow banking or elsewhere. Then regulators need to be aware of this and monitoring it, I suppose. Key challenge for Solvency II is its approach to equivalence. Again, if risk ends up transferring out of Europe as a result of Solvency II, then there's a major question around equivalence. We were also suggesting that the bank safety nets might be impacted by increased issuance of covered bonds. So covered bonds, I suppose, end up with a higher priority, so therefore depositors end up with lower protection if more covered bonds are issued by banks. So therefore there's quite a lot of public policy considerations to bear in mind if we end up with excessive risk transfer to customers. And again, we suggest empirical investigation would be useful. So I suppose to summarize the paper in one slide, we have had two substantially independent development, but the two of them should be largely coincident in terms of their timing. So therefore there's significant scope for unintended consequences in the areas of cost of capital, funding, and risk migration. And we felt really that policy response should consider those public policy questions and should have further empirical investigation when looking at the potential magnitude of the impact of those unintended consequences. So that finishes our paper now. I hand back to
Thank Chairman. You very much. Great. I now would like to invite Andrew Chamberlain to open the discussion.
This paper sets out to address important issues. In paragraph 4, the authors describe their objectives and the parameters they set themselves. Whilst the designers of Basel III and Solvency II might dispute it, I think the authors are justified in focusing on Pillar 1 minimum capital requirements as these are the main influences of so many actions by both banks and insurers. Taking the paper as a whole, I do wonder if the authors have erred in insufficient differentiation of non-life insurers from life insurers. I believe some of their analysis would be simpler had that difference been given greater prominence. Paragraph 12 considers liquidity risks to insurers. Whilst I'd agree with the thrust of this paragraph, I do feel the underlying issue with lapse risk has been misunderstood, as it's not the availability of funds, but rather the loss of profit that is more often the concern in mass lapse scenarios. Accounting issues are covered in section 2b. Here I suspect the authors have taken some of the EU propaganda on Solvency II at face value. Insurance liabilities values under Solvency II bear only superficial links to arm's length transaction values. Indeed, the extent to which some valuations, as presently intended, relate to such values arise only from the power a Pillar 1 basis can have in driving transaction prices, a circularity. The value of annuity liabilities is a case in point. As an aside, the IMF published a technical note on EIOPA in this month, March 2013, which appears blind to the consequences of strict market consistency, which can, under a 0.5% stress condition, lead to phantom insolvencies. In paragraph 23, the authors point out a material difference in the valuation of assets. In the second bullet of that paragraph, the irony that an insurer who is unlikely to have to realise assets subject to credit spread reports greater volatility from that source than a bank will not have been lost on those present tonight. The exposition of the key features of Basel III and Solvency II in the paper is very welcome and useful. I sympathise with the authors who, whenever they'd finished writing, would have found Solvency II had made some material change afterwards. Paragraph 44 perhaps most clearly illustrates their problem with the timetable it quotes. Nevertheless, the paper is valuable in the consideration of the fundamentals of the two systems. The contrast between paragraphs 79 and 82 on the capital risks is a matter I hope others in the discussion will comment on. Section 6 is, however, I think, the nub of the paper, the unintended consequences. The cost of capital, subsection A, does, in places, perhaps implicitly assume that relative change is not intended. There's not a level capital playing field today between banks and insurers, so change may in some cases be a rectification, not an unbalancing of the situation. I do feel the authors also perhaps misjudge reinsurance, which is a mechanism critical to insurance markets, and not only a risk mitigant, but a means of risk transference. I do, however, think, though, this section on cost of capital is particularly important, and I hope others will comment. One point the authors do not make is that ultimately excessive capital requirements will be paid for by consumers. Paragraph 119 looks at one side of the issue of transference of risk back to consumers, but where risk is retained by institutions but capital charges are very high, the price to the consumer must rise. In paragraph 125, the Solvency II balance sheet is described as realistic. I would challenge this, at least as Solvency II is being described today. It might be different tomorrow, of course. Political moves since the initial concept have moved the balance sheet some way from reality in places into a very conservative world. I do hope the discussion tonight will do greater justice to the important issues the authors raise than I can in the time allotted to me, but I would like to thank the authors for their highly informative paper.
Thank you very much. is now open to the floor, and I'm looking forward to an interesting and stimulating debate, and would like to encourage as many members as possible who wish to contribute to do so. Please do not let the fact that the meeting is being recorded deter you from contributing. You will be given the opportunity to edit your remarks before publication in the British Actuarial Journal. For that reason, please do state your name before making a contribution. If you can, please come forward and speak from the lectern. The sound system worked better, and it also works more effectively as far as the video recording is concerned. Please, if you do make a contribution, speak into the microphone. I would now like to throw the meeting open for discussion. Who would like to go first? Please.
Hello, I'm Louise Pryor. Many thanks to the authors for such an interesting paper. The parallel structure of the discussion of the banking and insurance industries was especially valuable, and I think the level of detail will undoubtedly make the paper an essential reference. It's a great paper. There's a but coming, you could tell. I'm not sure that they've placed enough emphasis on the differing objectives of Basel II and Solvency II, or possibly what I mean is what the differing objectives should be. As Malcolm discussed in his introduction, the insurance and banking industries play different roles in society. The paper mentions the issue in paragraphs 124 and 125, and especially footnote 74, and I think that says something probably good about the paper, that it has at least 74 footnotes, where it says that the nature of capital needed by banks and insurers is naturally different because of their different business models. And they note the possibility of a belief by governments that they are less likely to incur material costs in bailing out insurers. I think this point deserves more prominence. The banking system and insurance industries interact with other parts of society in very different ways. And in particular, banking and insurance failures play out very differently and over different timescales. The network effects are different. It seems that contagion is rather more likely in banking than insurance. As an aside, actually, there's some interesting current research on mechanisms of contagion in banking networks. In fact, you could almost say there's a mini industry on it, which is lovely for some of us. I'm not aware of a similar trend in insurance, though I'd love to hear about it if it does exist. But it's likely that the ultimate effects of a banking system failure would be different from the ultimate effects of an insurance system failure, too. Though I think it would be simplistic to say that one would be more severe than the other. The immediate effects are certainly very different in terms of who picks up the tab in the short term, as the paper points out, but failures in the two systems will also have very different knock-on effects on industry and the economy in general. It's therefore entirely appropriate that the capital requirements should be different, as the consequences as well as the causes of failure are so different. And I think because of that, it's also entirely appropriate that the different capital requirements should encourage migration of risk between the two sectors. It would be lovely to think that all this had been rigorously thought through, but I suspect that the title of the paper has got it right, and that the interactions are on the whole unintended. In many cases, they might also be unexpected by those drafting the regulations at least. The paper suggests that empirical investigation of the effects would be a good thing, and I can't possibly disagree, but it does look like the real world will be running a gigantic experiment in a chaotic environment. It's going to be fascinating to watch, but let's just hope that enough of the effects are beneficial or at least benign.
Please.
Martin White, some observations that occurred to me during the presentation. If Solvency II is a principle-based framework, I think there's a little question. It's a little bit talking about economic growth without considering global warming. I think the elephant in the room, which we haven't talked about at all, is the integrity of the assets and liabilities in these institutions. I mean, I could ask hands up who believes a bank's accounts. I think we'd probably think that insurance accounts are slightly more trustworthy. One other thought, the cost of capital concept. I do wonder just where this comes from. Banks are expected to achieve a high rate of return on capital, which of course they do by heavily gearing. Is that really the result of an intelligent requirement from the shareholders, or is it something generated within the banking community to justify their rewards? But I thought the paper gave a superb comparison and drew all the threads together very well, absent this one point about integrity of the provisions. Thank you.
My name is Charles Pickup. I just have a question actually for the authors, which is what has the IMF done with this paper? In other words, has it changed anything, influenced anything, or is it just a kind of, oh, that's quite interesting, and it then goes on the shelf somewhere? Thank you.
That question now.
Yeah, okay. I think, as with most IMF working papers of this type, its main kind of raison d'etre is to generate discussion. The IMF actually has not as much power as you might otherwise expect, in at least when it comes to regulatory frameworks. So I'm not aware of it having explicitly altered some particular regulatory angle of either of these two things, but it has generated the debate and the discussion. But Padraic, do you have anything else you want to add?
To be honest, I'm not aware of any specific actions. I think it is the purpose of generating discussion and hopefully leading to further work in similar areas.
Well, I think we shouldn't be surprised by that answer, because the systems are being driven by very different regulators. The Basel III system being driven globally with a lot of influence from the financial stability boards, whereas as far as Solvency II is concerned, that is very much a European event, driven very specifically within the European bureaucracy. Just whilst people are getting their minds around any comments they wish to make, I just thought a couple. I had an interesting experience in the sense that I was the CFO of a systematically important insurer until I retired 4 years ago. And then I took up a non-executive role at RBS, the bank, and I chair the board risk committee there, which, not surprisingly, is incredibly involved with capital matters. And I really do support much of what this paper has analysed. I think it is the first piece of work that I've seen which is actually trying to bridge across the two systems, which are not being driven by any need or desire to be consistent, but at their basics, they are risk-based capital adequacy type systems. The one thing that I would have preferred to see slightly more brought out in the paper from my experiences is that Solvency II is very much a mark-to-market on the asset side with the risk-free rate of interest purely on the liability side. That is very different from the banking systems, and amongst other things, of course, you haven't got full mark to market. That is not the way the accounting systems require banks to report. Someone asked the question as to who in the room believes bank accounts. As a member of the audit committee of RBS, I have to say, yes, I do, but I believe that they are reporting in accordance with IFRS standards. And they are what they are. If I was in charge of IFRS standards for banks, then I would probably be trying to see some change, but they are reporting the way they are required to report. But there are real fundamental differences in the nature of the risks in banks and insurers, and there are really some fundamental differences of how the modelling actually works to assess what's on the liability side and what's on the asset side of the balance sheet. So with those thoughts, do we have any further contributions from the floor, please?
Chris O'Brien, a number of points for maybe for the authors. One is the paper talks about the differential effect on the cost of capital for banks and insurers. My recollection from the Treasury paper on the cost-benefit analysis for Solvency II is that they foresaw a reduction in the cost of capital for insurers, which was based upon, firstly, greater transparency, in that there would be more information in the public domain arising from Pillar 3, and also because of the increased security that there was going to be for policyholders and implicitly insurance companies less likely to fail from the risk-based capital regime that Solvency II was implementing. So that reduction in the cost of capital, my recollection is that played an important part of the benefits of Solvency II, because you only need a very small percentage reduction in the cost of capital multiplied by a large amount of capital in the industry to produce a big figure that is higher than the cost of implementation. So first question is, any comments about, is the cost of capital reducing for insurers? And secondly, the authors have referred to the way in which the origins of Basel III and Solvency II are quite different, and that Basel III is intended to apply worldwide if countries implement it, whereas Solvency II is driven by the European Union. Where does this leave the IAIS, the International Association of Insurance Supervisors? Because that is, in a sense, the equivalent body to the instigators of Basel III. So where is that in terms of principles for insurance regulation and minimum capital requirements? Indeed, has its role been usurped by the way that the Europeans are implementing Solvency II, which is then leading some other territories, in particular the US, to look at Solvency II developments and see how their own regulatory regime might need to adapt?
Thank you. Any further contributions from the floor, please? Okay, well, if there are no further contributions from the floor, before we ask the authors to respond to the discussion, I'd now like to invite James Tooley to close the discussion, and then we'll hear from the authors again.
Closing the discussion, it's normally the object is to pick out some key points and address them and broaden them, as it were. And the key points I wanted to pick out were comparisons, cost of capital, and mark to market. The paper is quite necessarily very strong on the comparisons between the two systems in front of us. And a very strong comment has been made that these differences entirely flow from the different situations, the different risks that the different industries pose. But I think, unfortunately, in a way, there are also very strong similarities. The paper and one of the authors in the introduction raised internal models as the banking view of internal models is entirely gloomy and suspicious. For an insurance industry that is, in theory, walking towards approval of a number of internal models, that is entirely unhelpful and a very much unintended consequence from the insurance industry's side of the street. Cost of capital has also got a fair bit of time and consideration, with pointing out that this may not be an unintended consequence. It may be a move to a better place, a better recognition. And the last contribution pointed out that HMT thought this was actually moving us to a lower cost of capital in the insurance industry because we are having a more transparent and understandable system being placed on us. That could easily be, of course, undermined by Andrew's comment that Solvency II, although it has on the tin mark to market and economic reality, in the political process, in the lobbying, that is acquiring a number of barnacles, shall we call it, and may not be quite the same transparent and obvious insight into an insurer's business as one hoped. Embedded value may yet live in the future. So cost of capital, unintended, might be unexpected, but quite possibly could be entirely positive. The last theme I'll just pick up is mark to market. It is quite easy for an insurer to, in many ways, look down on a bank's accounts, amortizing loans that have turned out to be drastically poor and causing continuous provisioning in the accounts of a bank. But one is always very conscious that our own mark-to-market purity is entirely dubious in the sense that it is a mathematical construct. It is very rarely testable against the market, and our new system will actually rely very heavily on the regulation and criteria being set down by Solvency II. We remain quite a regulatory-driven business in terms of how we recognise and present our balance sheet, and there are actually similarities with the banks because of that. Thank you.
Thank you very much, James. I'd now like to invite the authors to respond.
Well, thank you very much indeed to everyone who's contributed, to James and Andrew also for closing and opening the discussion. There have been some very useful comments and insights shared this evening. Martin White suggested that we all believe banks have the integrity of the balance sheet of insurers is maybe slightly more trustworthy than banks. My own anecdote in this area, when I was a fund manager a few years back, the fund managers tended to believe that they understood what banks did more than they understood what insurers did. So maybe the picture has changed in the last 5 or 10 years, but I think I would not underestimate the lack of clarity and lack of transparency that people have thought applied to certain insurance company balance sheets. And that maybe picks up on Chris O'Brien's comment about the Treasury consultation, where it was noted that greater transparency and greater clarity of what the balance sheet contains might actually help insurers. So an interesting juxtaposition there. We'll certainly take on board comments like Louise Pryor's about the greater, or perhaps a desire for greater emphasis on the different objectives between that banks and insurers place and the regulatory frameworks that are placed on them. I think Chris O'Brien picked up one other question to do with where does Basel III and Solvency II leave the IAIS. And some of the ideas of Solvency II are getting transmuted into a more global framework. For example, the concept of an ORSA is something that is now increasingly being referred to across the globe and not just within the EU context in isolation. So our hope is that you've found the paper interesting and informative, and as always with these things, if it's 2 years from when it was originally framed, things have moved on, and no doubt they will continue to move on. Do you have any final comments, Padraic?
Yeah, I was just going to add, I suppose, on the point regarding Solvency II and the IAIS that was raised by Chris O'Brien. I think it was the case that Solvency II was gaining more impetus globally, but to be honest, over the last couple of years and given the delays and so on with Solvency II, I think it has lost a lot of that impetus. And certainly when we look at the US, and they would be much stronger nowadays in terms of saying that their own system is preferable or more than they would have been a couple of years ago when they were looking at Solvency II, and it was becoming at a point when it was gaining more traction globally. I would echo Malcolm's comments in terms of thanking the various comments, and I would agree with a number of them. And again, I think the last couple of years have emphasized a number of points, such as market consistency and so on, and the extent to which the difficulties with market consistency in some scenarios, as Andrew mentioned, and so on. So I would thank everyone, and certainly would agree with a lot of the comments that have been made.
Thank you very much indeed. I guess the final thought for me is that I have no doubt that the Basel III system is significantly increasing the capital requirements on banks. And so it is needed. There's no doubt about the banks were woefully undercapitalised going into the financial crisis. I think the concern as far as banking capital is concerned has to be more as to whether the system is actually leading to excessive capitalisation of banks, because there's nothing more likely to reduce lending in the economy if capital requirement is calibrated too high. As far as Solvency II is concerned, my personal belief is why I don't expect it to be adopted outside of the European Union, is that I don't think we know whether it actually is likely to lead to higher capital requirements or lower capital requirements, because the system is designed to be highly volatile. And I think that if there's any one weakness from my perspective in Solvency II, is the degree of volatility that is built into the system, which I think will take a lot of experience to determine what is the right level of calibration. So finally, for me, it remains for me to express my thanks, and I'm sure the thanks of all of us to the authors, the opener and closer, and all those who participated in this evening's discussion. The next sessional research meeting here in London will be on the 22nd of April, when a discussion on difficult risks and capital models will take place. Also, following the success of the Emerging Trends in Mortality and Longevity Symposium 2011, an analysis of the feedback received, the Mortality Research Steering Group is planning a series of small events / workshops around key mortality themes to be held over the next 2 years, culminating in a major conference in September, October 2014. Further details will be available on the profession's website. I declare the meeting closed and invite you all to join me and the contributors on the platform to continue tonight's discussion over a glass of wine in the council chamber. Thank you very much indeed.